Hello and welcome, everyone. Thank you so much for joining us for today's State of Freight, presented by Uber Freight. My name is Julia Becker. I'm the Senior Content Marketing and Account Manager here at FreightWaves. I'll be your host, and I'm joined, as always, by FreightWaves founder and CEO Craig Fuller and Head of Freight Market Intelligence, Zach Strickland. Today's conversation will cover the latest insights from our Sonar platform, industry expertise, and an advanced look at peak season. Craig and Zach will also be answering all of your questions after our discussion today. But before we get started, I want to cover just a couple of quick items. First, if you have any issues during the webinar, please feel free to reach out to our team via that audience chat function in your webinar console, and we will be in touch to assist you. If you have questions that you'd like to ask Craig and Zach, you can enter those also in that Q&A box in your console, and we will rock through as many questions as we have time for at the end today. We'll also be sending a link to the recording of the webinar tomorrow if you'd like to view it on demand or share it with your team. And now I'll go ahead and turn it over to Zach.
All right, thank you for that, Julia. And thank you for tuning in to this month's State of Freight. And thanks to Craig for joining us here. So, Craig, I want to lead this State of Freight off with, you were at a conference this week, Groundbreakers for Prologis, and we just had a story come out of there, and I think it's extremely relevant to the current kind of climate. I mean, we've been in this economic, uncertain period, to say the least. And a lot of it centers around the fact that the Fed is fighting inflation continuously. Now, Prologis founder and CEO came out and said he thinks it's been a little too aggressive. I'd love to hear your kind of take on the current economic environment and what you kind of took away from this.
Yeah, it was a great event, brought together a number of big thinkers, high-profile thinkers across all parts of the economy, as well as folks that are in the innovation ecosystem that touch supply chain. So it's a great chance to sort of get on the front lines of what people are dealing with, both economically as well as in their operations. And I think generally I agree. I think the general sense that came out of that conversation is really twofold. One is, and we've talked about this before, but I think it was nice to hear it sort of affirmed from folks that are outside of our freight community, was that the federal government, the sort of branches of government, if you will, and the Fed is sort of supposed to be a non-political entity, but at the end of the day, their job is to set and probably have as much power, if not more power, than many branches of government. They have tried to tighten aggressively, or have not tried, but they have tightened aggressively to try to slow the economy down, hoping that that impacts inflation. And that's really the primary instrument of which that they do to control. By controlling the money supply, they're effectively mitigating potentially rate increases. On the other side of it, we have Congress and President Biden, which have created a lot of new stimulus bills over the last couple of years. And that stuff is hitting the economy at the same time. So what's happening is we're having a shift between the private sector and public sector, where the Federal Reserve, because the government, the U.S. government, the federal government, doesn't actually have to live within its means, hence the shutdown that we're all talking about. And therefore, it is sort of outside of the federal, the regime does not impact slowing, unfortunately. Right. The Federal Reserve does not impact congressional appropriations. So Congress can spend as much money as it deems fit at any moment in time. And it's doing so. Over the last couple of years, we've seen the infrastructure bill, the quote-unquote Inflation Reduction Act. We've seen all of these policies that have pumped trillions of dollars into the economy. And in doing so, it has created a lot of economic pressure, or have created demand, and has driven inflation, because things like construction labor, materials, and manufacturing is all being driven by these policies. At the same time, the Federal Reserve is trying to fight to slow the economy down and to mitigate prices. And the people that get impacted by that are folks that are in the private sector that are building, whether you're in real estate, we're talking about Prologis, it's building warehouses, it's consumer credit, it really takes a toll on consumers and on businesses. And so you have this really interesting pendulum, which is the economic activity during COVID was really consumer driven. And now this is predominantly, the economic activity is predominantly government driven, government spending driven. The problem that we've got is that consumers, particularly ones that live sort of paycheck to paycheck or within sort of very tight means are getting killed because of inflation on one side and tighter credit on the other side. So that is, I think, what everyone's responding to is the speed of which the Federal Reserve went to has made it such that it makes it difficult to sort of to take on any kind of risk because nobody knows when it's going to end, first of all. And the second thing is, like, as you make these changes, you significantly impact liquidity on bank balance sheets, you significantly impact the cost of capital. These are just completely different considerations. Again, the federal government does not have to worry about this.
Right.
They should, but they don't have to live within a set of means because effectively they can tell the Treasury to print money. So the Treasury's got to print money to cover the debt, but then the Federal Reserve is increasing the cost of capital, and that is slowing consumer spending, and it's just this weird world that we're in.
Yeah, and I want to pull up the chart of the Fed funds rate real quick here to kind of set the tone, because how this is going to apply in my mind to freight is that they're going to continue this hawkish policy until they probably can't continue it. And if you look at this chart, you can see that there's a lot of sharp up and down in the Fed funds rate. And almost every single time over the most, probably the past 30, 40 years, they raised the rates until a recession hit. And then they dropped them.
Because the Federal Reserve it's the policy they have. It's a political.
Yeah.
It is not a political organization that you and I can go vote for people. But it's an organization that's led by committees. Those committees are appointed. There is some politics that goes into this, but they're also using lagging government data. They rely upon a lot of different signal data. That stuff takes a while for them to sort of figure out what's happening. And, effectively, as they try to slow the economy, as we've seen, go back and just look at this chart right here, 2001 to 2004, all the way up to 2007. So we saw a reversal from sort of the late 90s, Y2K. We had September 11th that happened. Then we saw a lot of easing. Then we saw a reacceleration of tightening that happened. Well, we know what happens in 2007.
Right.
Is the economy collapsed. There was a lot of structural issues in the economy, but it didn't help when the Federal Reserve was changing the cost of capital.
Right.
Then when the market crashed, we basically went from 2009 to 2016 with very flat cost of capital.
Interest. Yeah.
Very low. And then a more very gradual tightening. It wasn't sharp tightening like we see now. And we saw what happened to the freight market in 2019. There was a freight recession that was as bad. Some people said it was as bad as the one in 2008. So we know that the Federal Reserve can actually slow the economy pretty quickly.
Right.
We know that they have had a tendency to overcorrect in terms of a policy. We are still seeing, in spite of tighter rates, we're still seeing a broader, and I'm not talking about from a freight economy, I'm talking about from a broader economy. We're still seeing broader activity looks, call it bullish, or at least looks healthy in the broader economy, the macro economy. The problem that you get is that a lot of those programs, a lot of what's driving that activity is largely related to government stimulus programs that were put on after COVID or in the middle of COVID. And that's creating this really weird dichotomy. When those programs roll off, and eventually they will, when that funding stimulus rolls off, we are probably going to have a pretty nasty hangover that we're in tune for. Now, I haven't studied when these programs roll off, but they take a couple of years before they fund it and they sort of do it.
Right.
So I think we've got some time. We're sort of kicking the can down the road, but it is an issue. And the issue right now is consumers are tapped. Consumer credit is as tight as it's has been. Consumers are tapping out. I think J.P. Morgan said that the consumers will have consumed all of their all of their savings, really by the end of Q1 of next year. So we're seeing a situation where consumers are tapped. Student loans are starting to roll out. Student loan deferments rolling out. The housing market is getting killed by high rates. The auto market auto loan market is getting killed by high rates. So all these things are happening. It's just not a good thing.
Yeah. So, and the purpose of that.
One last point. Sorry. One last point I'll make is, in spite of all that, in spite of the tightening, and in spite of all the pressure on consumers, we still have a very strong labor market, and we still are experiencing inflation.
Right.
And that's because the government stimulus is outside of that.
So I want to shift into the freight market here a little bit. And the point was not to be critical of policy or anything like that. It is what it is. We're here to deal with it. And I think it's important that everybody sees that this is a thing that happens typically in the past. In these environments, we tend to go until we get into a recessionary state of being. So the next chart I want to pull up here, our OTVI, Outbound Tender Volume Index, as we transition into the freight market. And as you said, economically speaking, we're actually not in a terrible spot today. And the freight market itself, even though it may feel like a very bleak environment to a lot of operators and transportation providers, we've seen this uptick in demand kind of continue.
Look at the white chart. So the white chart is this year's activity.
Yeah.
The magenta or purple.
Fuchsia.
Is it fuchsia?
Fuchsia.
Okay. Well, it's not magenta. Magenta is like the T-Mobile color is magenta, right?
Yeah.
So okay, fuchsia was 2019's level, and then green is 2022. That's a year ago.
Yeah.
We're looking at a market where, sort of go back to where this chart starts, or at least on the sort of far left side of that chart. The white, we're seeing current freight volume at higher levels than we've seen at almost any time this year. And it's continuing to accelerate throughout the year. But you go out and listen to all of the channel checks or anecdotal statements, and everyone talks about how soft it is. What they're not talking about, or what isn't often referred to, they say the economy's slow. What they're actually talking about is the overcapacity, the overabundance of the number of trucks. Because you can look at the volume data actually looks fairly robust. If you took that green chart out, Zach, and you got rid of the green chart from last year, you would say this looks like a really strong recovery outside of well above 2019 levels, and certainly well above where we started the year. But you go ask anyone in the market, they would disagree with you. They're not seeing it. And the reason they're not seeing it is that we've had this overabundance of capacity that entered the market, and it still exists. And so we're about, if we're fortunate as an industry, go back to that chart 1 second. I want to point out one more thing on it. If this pace continues, at least even if it stays flat and continues through October, we will enter a period where the year-over-year comps will be better in terms of volume. But here's where it gets tricky, because you can't mention volume and describe the state of the freight market for participants. You have to mention capacity.
Right.
And the best way, there's two indicators I look at to understand the balance of supply and demand. One is obviously rates are really important for that, because everyone's concerned about rate. And the second piece of that is the tender rejection data, which is what is the market reacting on a given day in terms of the percent of truckloads that are being rejected or turned down. And as we see that tighten, as we see that number go up, we know that everything else will go up, including sentiment. And right now, we saw a nice bounce back from mid-May was sort of the lowest part of the market, about 2.5% rejections. We're at 3.74 today. But what's interesting is we were in the mid-4s. Like if you go back to right before Labor Day, we were in the mid-4s.
Right.
And so we've fallen back some. We're about halfway. We've retracted about halfway back to the low. And so what's causing that? Well, I think we have sort of argued that it's not volume.
Right.
Because we have argued that the volume data has said things are stronger. I think what you have to look at is the abundance of capacity. And that is effectively what the market's telling us.
Yeah, and so the tender rejection index that we showed you there, you can see that it's actually on the floor. Like it's as low as it's been this time of year. The white line that you're looking at there, last year is the green line. We're below that, even though last year was arguably a very soft, but we're also below 2019 in terms of total rejections. And that is on higher demand. So I think the story in my mind here is, how far do we have to go with capacity growth? Like how close are we to that point where we start to see that rejection rate and spot rate start to turn up?
I had this conversation recently, with someone on a Wall Street fund. And, it's interesting because they're sort of, I think Wall Street's a really interesting animal, and people that work on Wall Street tend to be more objective than we are in an industry. Because the reason that they're more objective is if they're trading the market, if they haven't made a position, the reason they tend to be more objective is they have to be right. Like, they have to get their theses correct. So they do a lot of testing. Like, they don't have bias like an asset-based trucking company has biases. A shipper has biases. A broker has biases. A driver has biases. But if you're on Wall Street, even though you may have bias, if you have money in an instrument, you have bias. If you're trading big money, you got to get it right. And so what's interesting about that is the big questions. If we go back and sort of look at the rejection level for a second, I want to point this out. What we see is pretty anemic conditions. We have argued today that volumes are not responsible for the anemic conditions. So it has to be capacity driven. But every one of the asset-based carriers and analysts over the last year have argued that the soft conditions, we have also argued this, so we're certainly not blaming carrier executives, because it was my thesis as well, is that as the market conditions have loosened, as the freight recession has played out, as rejection rates have been low, and as rates have been very low, that should cause a lot of trucking companies to churn out of the market. And we have not seen that. We have not seen a wholesale departure of capacity. We still have too much capacity. Let's go to the next chart, which is the revocation data. I think this is really interesting because you can see in this chart, and again, we only have data back to mid-2018, so we were not going that far.
We have a little bit further, but it doesn't tell you much different.
So you see the green is sort of an expansion. So anything that's above zero that's in green is when the market's expanding. You see the freight recession measured in red. You see that happen in 2019. And then you see the 2020 recovery, the COVID recovery, and then the COVID abundance of new carriers. And we've been living in the freight recession, according to this chart, really since the second quarter of last year, which matches what we've always argued.
Right.
We have seen carriers turn out. Like, we're seeing that. You're seeing that happen right now.
Right.
Negative 340 operating authorities, and this is weekly, correct? This is weekly data. Yeah. But you look at those charts and you overlay them, the depth of the increases, if you put those charts together, there were far more increases in the trucking market than there had been revocations.
Right.
And for longer.
Right.
Like, you look at the chart, you really have, if you stay in the green period, which is what we're looking at,
right,
you have basically, we're talking from the COVID cycle, from that last red tick that's in March of 2020, you basically have, almost at least 2 years and almost 3 years of expansionary activity at much greater heights. Because look at the peak. It's 2,000 new carriers a week, and the lowest paint on the recessionary point is less than 1,000.
Right.
So we talked about the expansion being so much greater than the revocations. And so if you follow this data for a while, it would suggest to me that we're going to be in the soup a lot longer than what a lot of people believe they are, not because the freight market is slow, but because activity to my carrier is slow because there's too much capacity.
Right. So, I mean, if you look at this, I think the number you're describing, we've netted about 100,000
new carriers.
New carriers, and that includes the revocations.
We're not talking. These are trucking authorities, right?
Right.
100,000 new trucking companies that have popped up, and the average of these carriers is it's in that 1 to 2 to 3 mark. But there was also expansion of fleets that may have continued to expand their fleets. So we're in a situation where there's so much capacity. The question is why? This is what I want to get to.
Okay.
It's one thing to say it's happening. We all agree it's happening. I mean, everyone is sort of seeing soft conditions and said, hey, this isn't what I expected. I will be one to also say that I didn't expect it to go on this long. I certainly thought that we would have seen a washout last year. If it followed normal market patterns, it should have. The question is why? Well, we all have sort of talked about and pointed out the fact that carriers did well They were able during the COVID cycle to reserve a lot of cash, pay off debt, and they did exceptionally well. That probably has played out for most carriers. They've lived in this sort of tough environment for the last, 16 months or so. So they may have burned all the cash, but how are they still sticking around? Like, how are they effectively in that cockroach phase where they, aren't just going under? And what I'll argue is that, and you look at these carrier executives have been doing this for decades, have largely made these statements based on their own experiences or historical data. And they've gone back, some of these carrier executives have been doing this for decades. And they are drawing the conclusions about the current market based on the experience of the past. And frankly, that's what you should do. It's what I do, it's what you do. The difference that no one is talking about, or at least I haven't heard this broadly, is the proliferation of freight brokerage. So let's go back to the last major downturn that we had in the overall freight market. So it was 2019 was the last downturn, but it didn't last very long. You can see it right here in this chart is the tail end of 2019 was a tough, difficult market. It was a freight recession. It was a bloodbath, as Rachel Premack likes to say, but it was not a really deep environment. The last major downturn in freight was 2008 with the entire U.S. economy, or global economy, that really dipped. Freight brokerage, back in those days, represented about 10% of the overall freight that's moving. And I'm using data, Evan Armstrong and Statistica has this great chart that shows the percent of freight managed by freight brokers. And sort of pre the great financial crisis, you can find this on the web, it was approximately 10% of the freight that moved was through freight brokers. Today, and this is the last data point that they have in their chart, this chart was posted, by the way, in 2019. The last data point they show is as much as 19%. I think by some of our estimates, freight brokerage during the COVID extremes could be as much as a third of truckload freight moved. And the reason that these small guys are able to hang on, that they weren't able to hang on before, is because they've been able to access freight so much easier than they've ever were able to do it in the past markets. Because what happened when the market got soft is the guys that lived on the next load, all that freight dried up for them. So it wasn't just the rates were cheap, but it was the fact that they didn't have any volume. They couldn't keep moving. But the proliferation of companies like Uber Freight, Convoy, the sort of massive growth of C.H. Robinson over the last decade, the Coyotes, we can go and name every single freight broker, we'll be all day, JB Hunt 360, all this, is a relatively recent phenomenon in the past decade. I left the trucking business in 2005. When I was in the trucking business back in the day, the ancient times, freight brokerage was a cottage industry. It was usually the stuff that nobody wanted. It was
discount freight.
It was discount freight. That's a great point. But what's happened over the last 20 years is that there's been so much investment, and you can argue that companies like Transplace in the day, or XP Menlo Logistics, or XPO, or Penske and Ryder, all that managed trans business, which is sort of what existed back in my day, they actually took a lot of freight, started to show up across every major freight brokerage. And what we see is this entirely new generation of entities that have taken on a significant place in the routing guide. So now we see a situation where, because again, my ancient day, when we walked uphill both ways, in my day, the freight brokers never were a participant in the routing guide. They were sort of the people that you called when you couldn't get a truck or you had a really bad lane that you couldn't find someone to service it or you had an emergency. That's changed. And now freight brokers are often a top participant in a routing guide, and sometimes have replaced asset-based carriers. So now Jim Bob Trucking, who would normally in past cycles no longer work in our industry, Jim Bob is able to survive, not thrive, but able to survive a lot longer with just enough cash to stay in the game. And the issue is that as long as freight brokerage continues to have significant share of the market, because they can chase the rate all the way down, they can also chase it all the way up. As long as they're providing freight opportunities for these guys, for Jim Bob, he doesn't have anywhere to go. And I think that's what's driving the carriers living on a lot longer, because it does not follow historical models. But it's that market share element of the 3PL industry that is largely being discounted in the cycle.
So that's a fascinating point. Like I think you're making a good logical argument there for the freight brokerage, kind of allowing some of these smaller carriers that normally would have to go and source their own freight. They don't have the networks to go and expand to all the different shippers out there. So now they're actually able to hang on with some utilization that they wouldn't have had in the past, thanks to freight brokerage, technology, more visibility in the industry.
Systems and able to access higher quality freight pools.
Right.
They don't have to deal with the infrastructure that a large asset carrier does. They can essentially survive.
Right.
And I think that's what's happening. They may not be doing well and thriving, but I think that's driving a relatively new development. Because the old days, what would happen is when the economy went south, the freight brokerage, all that incremental freight would just dry up. Today, what's happening is the freight brokers are getting ahead of this, and they're chasing the rate down to make sure they maintain volume, and that's what's effectively driving a lot of the opportunities to keep them moving. So
that's a perfect segue into the next data point I want to pull up here, and that's the rates, the contract rates and the spot rates for dry van freight, which of course represents the gross majority of the freight moving in the United States. So dry van contract rates, represented in the white line here, Craig, is effectively kind of stalling out right now. We've seen this flattening over the course of the summer. Now, there's a couple of things that might be happening here. I'd like to get your take on it. One of my takes is that it's the summer. There's not a lot of new implementation in the summer. It's a little, we saw it during 2022. Even when the market took a sharp turn down, especially in the spot market, which is represented in the blue line, the contract market leveled out over the summer. It's not bid season. Not a lot of new negotiations going on, unlike during the period of COVID. But it looks like we might be, and this is supported by a stabilizing spot market rate. So do you think that this chart is showing us that the rates are finding a floor in the market right now?
It's interesting you say about contract rates,
Yeah.
because you're still the delta, the spread that we like to call
huge.
Rates,
Yeah.
about 62 cents a mile according to this chart. So you're in a situation where the spread between the spot rate and the contract rate are such, and what you've got is a little bit of fuel. So you're using NTIL 12, just so everyone is aware of that. That's a $1.20 base fuel. Most of the contract rates have some degree of fuel in there in them.
Right.
And so what you're looking at is that base of fuel sort of compares the two charts, because spot rates have zero fuel as we strip it out. And in your case, in the contract rate, it usually has some base fuel.
A little base fuel then.
Part of it could be that maybe the contract rate isn't, has more fuel in it, is responding to some diesel costs, because we've seen diesel accelerate since then. And so, sometimes, even though they don't have that fuel base that's not transparent in the data, there's still some impact on fuel. But I think largely what's happening, to your point, and I certainly didn't think we would see the bottom of contract rates at $2.36 a mile.
Right.
I thought it would continue to go down. But what the data is telling us is different. And this is the whole thing is, when data is contradicting our theories, we have to respond to the data. The data is telling us that contract rates are unlikely to head any further, is what I would see in this chart. We've seen it kind of bounce along the bottom. And spot rates also have likely seen the lows of the market. Unless we see an economic collapse, I don't think we will see a situation where contract rates get much cheaper, nor will we see spot rates get much cheaper.
Do you think that there's kind of a divergence in behavior in the two markets right now? Like you said, you have freight brokers, smaller operators, really driving the spot market activity to a point. Obviously, there's still larger carriers in there as well. But do you think we're seeing a change in behavior just in the dynamic in the relationship? Because like you said, that spread is still suggesting there's a lot of room in the contract market if you look back to that 2019 level.
For sure. I think the difference is the spot rate. So let's think about this. Let's go back to this thread about freight brokers, because it's a running thread in my mind about what's happening, trying to interpret the signals in the data. is that a lot of the carriers that operate in the contract market have infrastructure. They have personnel. They have a pretty good understanding of their costs. They sort of know what it costs to run it. The people that are taking spot freight often it's one or two sort of scenarios. One is they're taking it as a backhaul and they're just trying to move a truck, which happens quite a bit, particularly in a soft market. The second thing is they don't have that infrastructure that they have to draw on. So what may have happened is over the last couple of years is that the fleet executives, the fleets, their costs went up significantly back office, not contributing to line haul services, but all the back office went up. And it sort of hit a floor. The carriers realized they can't operate profitably. Therefore, en masse, they're not heavily discounting the freight any further because it's gone as far as it will go. Spot rate, though, is telling us that there is further room to fall. It is quite possible that this new level of spread is exactly what we've been communicating, which is the guys that live in the spot market don't have the infrastructure, and it's the freight brokers that make up that piece. Think about this for a second. Is if you're a single operator, you don't have a sales force, you don't have infrastructure that you have to afford to keep your truck moving. If you're a fleet with 100 trucks or 500 trucks or 1,000, whatever, you've got a safety department, you have an OS&D claims department, you've got a dispatcher, you've got a customer service department, you have a sales team. You have a lot of stuff going in to keep your trucks moving, right? They don't actually drive the truck. The people that are filling that void are the freight brokers, and what we're looking at as spot is the purchase. It is very possible that what we're actually looking at is that freight brokerage as a percent of a transaction is they're not expanding their margins per se in terms of profitability, but it's quite possible that they are taking on a greater share of the responsibility for the carrier, and therefore they're able to sort of maintain a higher margin, but yet still have substantial people costs inside of it. So it is quite possible that what we're seeing here is a situation where the small single solo operators are the ones keeping the spot rates low, and the fleets that operate the market are keeping them higher.
Yeah, and I want to show the chart. I think this puts it into a little bit deeper perspective. It's the same information on the rates chart here that I'm pulling up. This is the spread between the two. This is the difference between that white line and the blue line that you saw, and you see that white horizontal figure is where we were in 2019, historically loose market. But like you said, this market's looser. And
it's the spread is higher.
Yeah.
And until we see capacity tighten, spot rates are not going to run.
Right.
And so, but it's possible that contract rates have hit a floor.
Some semblance of a floor. That's an interesting theory. And of course, bid season is coming up. Peak season along with it, the historical peak season. So I want to get your take on another chart that I want to pull up here. So just for, I think most people that watch this, and maybe they don't, that historically in trucking, transportation, shipping, we consider peak season right around the holiday period. You know, it's the third, fourth quarter where we see retail.
It runs from Columbus Day.
Tends to really
like
ramp
that
up.
Early October to really, you start to see West Coast freight move inbound from sort of early October to Christmas.
And what we've seen this year, and this is a chart of our OTVI split into the various lengths of haul. The only thing you really need to know here is that white line is representation of loads moving more than 800 miles.
Yep.
This is the type of freight that tends to move in the month of September and October. So it's no shock that we see this bulging long haul volume in September. However, this long haul volume has been growing kind of unseasonably since July of this year. And the other freight has been rising as well in general, but not necessarily as strongly. This to me is a fascinating development because this somewhat indicates that inventory cycle, because when you're talking about long haul freight, you just said it, West Coast to East Coast. We've seen the East Coast also kind of take over some of that long haul volume after the COVID supply chain issues with the ports. Long haul volume has come back with a vengeance. Do you think this supports inventory correction?
I think it supports that the inventory is corrected. Mm-hmm. I think to your point, if you look at when this broke out, it broke out really in the third quarter.
Right.
So it really started in July. Let's not forget that if you sort of go back to last year, in the start of the third quarter in July, this is, from really May to July was when we started to get a lot of reports of retailers had excess inventory.
Right.
It's also, early June of last year is when Henry Byers wrote his article about imports dropping off a cliff. We saw the drawdown in imports.
Right.
A lot of imports take 6 to 12 months, and sometimes as much as 2 years. Retailers are doing substantial amount of inventory planning at least 6 months out, and oftentimes much longer times. And we're a year into this. We're in a year to the slowdown. We're in a year into the freight market correction. China has really struggled, not just because of the U.S. consumer and the inventory overhang, but also because of global consumers have also slowed down spending. And it's quite possible that a lot of the retailers found that they could clear out their inventory and then go find substantial discounts, both on freight movement, the cost of moving containers, but also just on price concessions that they got from Chinese manufacturers, some original manufacturers that were willing to be more aggressive to go help them do it. So we saw, what we're seeing is an earlier peak season in the ocean market. In fact, there's a lot of data that's coming out about the ocean peak season, is that the ocean peak season happened actually much earlier this year than it did in past cycles, which supports your assessment that this is an inventory correction story than it is anything else.
Yeah, and I want to pull up to your point, the ocean story as well. We have multiple data points that corroborate this idea that inventories have corrected. And I want to show the IOTI here, which is the maritime volumes, along with the customs volume. So we see the white line. This is, bookings data for people placing orders for 20-foot equivalent units coming into the United States. The green line is stuff that's cleared customs. We can see a clear drop-off last year in the overall import volume. Now we're seeing the white line specifically has been creeping higher. So there's two things that I think we have to talk about. One is inventory corrections. Is this largely due to that? Or are people getting more optimistic about upcoming peak season demand as well?
It's hard to say. I mean, look, I think retailers, again, let's think of the ocean cycle. Trucking, let's compare trucking for ocean. Trucking will respond to near-term inputs and changes in supply and demand. You saw it during COVID, in the early parts of COVID. We've seen it on the tail end of COVID, where, the ocean market was still very robust, even after the trucking market collapsed last year. The ocean market was still sort of sorting out its mess. And it was not until about 6 months after the trucking market came back before we saw a real tightening in the ocean container volumes. Ocean just takes a lot longer. It's confusing for us practitioners in the space because we think about the natural flow of goods from sort of ship to truck or ship to rail to truck. We think about that's how it should work. But what we see in trucking is near-term changes in supply and demand. I don't think this is a sentiment indicator. I think what you're actually looking at, because these are not sentiment indicators to begin with, it's not that they have more confidence, it's that they burned off their inventory. The consumer has stayed fairly robust versus expectations. And I think what's happening is that those retailers went out and got aggressive deals done in the market. Cost of moving, it's cheaper. There is no near-term immediate pressure, so they can go take their time. And they were able to cut deals on products that are able to deliver savings to consumers that they haven't been able to do. They're going back to normal.
Right.
Like what we're seeing here is a more normalization of a supply chain that's operating on a more traditional sort of speed and cadence. And I think what you're seeing is that the U.S. consumer has stayed fairly robust through this cycle, even when they've had some softness. And that appears to continue. And I think retailers are certainly not going to be without. Even though they're not, I don't think anyone's expecting a huge holiday season from what I've read. I think everyone's saying, hey, the consumer's still in a pretty good shape. I'm still going to offer them product.
And of course, at the end of the day, there's still a lot of capacity.
There's still a lot of ocean capacity, and there's still a lot of trucking capacity, and they're benefiting from that. But it makes sense for them to move freight into the shores when they could get containers at $800 or $900 a TEU. Yeah,
do you think some of that inventory buildup or that replenishment is just taking deals?
Oh, I think absolutely. Like if you sort of look at the data that comes out of China, and I'm not talking about official government data, I'm talking more anecdotal data or data that's from third parties that are not government, I wouldn't say influenced, but are not government entities. The Chinese economy has really slowed this year, and it's largely export manufacturing that's been challenged. Absolutely, Walmart. They said this. I think it was a year ago. They said that they're done basically passing on inflation costs to consumers, and they put notice of all their suppliers. We're done, which means you're done,
right?
And we're not taking it anymore. And that they sent buyers over to China or made them come to the U.S. and said, it's time to get some discounts. And Walmart's not the only one. You see it across the board with all major retailers.
Yeah, so I want to show one last chart to hit on the intermodal rail sector, also kind of supporting this resurgence of long-haul growth. Intermodal volumes tend to peak around this time of year. We're finally seeing some decent growth coming after Labor Day. If you look at the white line, this is loaded container volumes for domestic and international containers, largely biased towards long-haul freight in general. It's finally recovering as well. Do you think that the intermodal sector is actually in a position, after being subdued relative to trucking, to kind of bring back some of this volume away from trucking?
Oh, yeah. I think, it's interesting because some of it is caused by some of the reason the intermodal market lost freight was service quality, chassis availability, things like that. But there was also a period of time, and there is a period of time when this happens, where trucking spot rates are so cheap,
right,
that shippers will take advantage of those low rates, and just move freight on a direct truckload versus moving it through intermodal. What has happened though is a lot of the intermodal carriers have sort of realized that they have to go fight for share, and have been responding to that in their bid cycles. They've had time. Intermodal bids are not like trucking bids.
Right.
They tend to be higher volume, and they tend to be much more price sensitive, and they happen on more specific cycles than you see with the broader sort of truckload stuff. So in the sense of what we're seeing now is that the intermodal market has largely corrected. I mean, if you take this chart and just look at this for a second, this white line that we see, which is this year, and you remove all the other noise around all the other years, that would be a really solid year.
Right.
Like, this is a really solid year in freight. And if you told people that this was a great year in freight, they would think you're nuts if they were in the industry. But on a volume standpoint, it looks pretty robust. In intermodal, it looks pretty robust.
Relative to history.
Relative to history. And so, look, if you're thinking about who's doing well, it's the companies that have, capacity connected to the railroads. It's companies that are servicing intermodal capacity connected to railroads. It's companies that are servicing intermodal. The other thing you got to remember is that intermodal doesn't do well when you have very tight time frames.
Right.
If I need freight now, I don't want to move on rail because the inventory is being replenished. Times are not as high pressure. That favors an intermodal market.
Right.
And so there's a lot going on here, and I think this is what we're seeing is also, we're seeing some sort of circumstantial data change on lanes. West Coast is not as important in terms of percentage of the freight. We're seeing freight now come out of Laredo is playing a much bigger, more prominent role in the freight market. So we are seeing some shifts that is also driving some of the different types of data points. We have just come through a pretty profound period in freight history, and I think we'll look back, if you sort of look at the major sort of periods in history in freight, NAFTA in the 90s, the sort of invention of the big box retailer in the 80s, the distribution stores really changed that long haul in favor of that long haul market. WTO with China in 2003, the great financial crisis, sort of the digitization of freight that happened in sort of the 2010 to 2020 mark, the COVID cycle. We're in a new generation of freight. We'll look back in 10 years and remark about how things are different now than they were before.
Yeah, I agree with that. All right, I want to pause there and let's leave some time for Q&A.
Awesome. Thanks, Zach. We are going to roll through those questions from everyone in the audience. So if you haven't already submitted your questions, go ahead and type those in that Q&A box. We've got a bunch of great questions already, so I will dive right in. This question is from Thomas, who asks, we're hearing a lot of carriers hinting at needing increased rates. What is your forecast for freight rates in 2024?
Yeah, I mean, I think I think we're going to see an inflection point with rates eventually. And whereas I don't know that demand is going to be the thing that holds them up, I think that we are going to see capacity correct quickly, in my mind. And I don't know, Craig, what your take is on the capacity correction speed, but I feel like we're due for an acceleration. One, because it always happens around Christmas. Every year, that's when most, and the data supports this, if you looked at that carrier exits or the net revenue vacations, they park their trucks the week before Christmas, knowing that January is typically one of the softest months of the year. And also, we've got increasing fuel costs, and they're rising rapidly right now. That is going to erode things in an environment that they cannot pass these costs along. And I think eventually, and I wasn't really thinking about your freight brokerage situation, I think that may hold it off for a little bit longer than we expect, but I think eventually it will accelerate some capacity. And in 2024, I think we're finally going to see not necessarily a spike in rates, but I think we're going to see a little bit of a directional shift.
I hope you're right. I don't know that you are.
Yeah.
I actually hope that you're right, because I think it would be healthier for everybody in the market to have a healthy trucking market, even for shippers. I mean, look, I think shippers in particular were really, really killed through the massive increase in rate and not being able to get their hands on trucks. But I think the shippers I talked to are perfectly fine paying slightly higher rates if it means that the industry is healthier.
Right.
All created equal, everyone wants a strong trucking market. So I hope you're right. I think a lot of people hope you're right. I don't know that you are. This overhang in capacity has played out for a long time, and we could be in it for a long time. You know, we're talking something, what was the number you said in terms of net
100,000.
About 100,000 trucks. And if you go back to the data that you had, we're seeing about 400 assets a week, or 400, not assets, but 400 operating authorities a week. 343 is the number right there. Below in that number, the range is sort of 1,000. But think about how many weeks it would take, even at 1,000, to burn off that 100,000 capacity.
Right.
You're talking about 2 years, and we're not at that. We're about.
That's why I think there's going to be an acceleration at some point.
There could be an acceleration.
The tender rejection rate.
We won't experience a crunch that's going to drive rates to.
Oh, I don't think we're going to see a spike in rates by any means. But this rejection rate being where it is at 3.74% is as unsustainable as the 20%. Now,
without a doubt. But go to other commodity markets, like the oil markets. For years lived in the $25 to $40 range, from 2010 to or 2014 to 2020. I mean, it stayed at a very tight range.
Right.
Oil prices did, pretty much oftentimes right above. So if you think about U.S. oil producers, most oil producers break even was like $35, and it would sort of teeter at that 35 level. Now they got more efficient. The really good ones got more efficient. The ones that didn't. But the problem was it stayed in a very tight range. Who says that rejection rates are supposed to be at 10%? We've been studying this data since 2018. We're the only folks that have the data. So like in terms of market level tender rejection data, there's no rule that says it has to be at 10%.
I didn't think we would have 20% as long as we did.
I agree, but remember what caused that was the largest capacity crunch in history.
Right.
And this arguably could have been the largest capacity glut in history.
Right.
And there's nothing to suggest that it will tighten. There's nothing to suggest that it is tightening. We will probably see some holiday run, but it's too early for where I sit to sort of talk about any kind of crunch. I was hoping, if you follow me on Twitter, I became more bullish and became starting to talk constructively about sort of a turnaround in the market. But recent data points have given me pause to that, because when I look at volume data and I look at a rate per mile and I look at tender rejection data, we're not seeing the follow through that I want to see in the market. So I don't know. I am not yet buying into a bull thesis in 24. We could be in a worse shape for longer. We'll see.
Right on.
My next question has been asked by a couple of folks in the audience. Will the UAW strike affect capacity and potentially cause a shift in the market trend?
great question. I actually think we're seeing that right now. I think it's one of the reasons that the September boom, or what we came into relative boom. I know we're talking about not being soft, but like we saw some constructive momentum come in. You would expect from Labor Day to the end of September is usually a good time in trucking. That's when you see, people move stuff to the end of the third quarter, a start of the peak season, or start to build that sort of foundation for peak season. It's really petered out in mid-September. That's, in my view, largely the auto strike is probably driving some softness. And in doing so, in driving some softness, it is showing up. I mean, truckload data, it's hard to get an exact number on how much of the truckload data is automotive.
Right.
But, ranges of things that I've read and studied is anywhere from the low end, about 4% to 8% is the automotive thing. Let's keep in mind that not every plant of the UAWs was shut down. Also, the big three manufacturers are not 100% of the freight market.
Right.
Maybe half. I don't know the exact number on that, but they're, people like Toyota and Honda and Volkswagen and BMW and Mercedes still produce cars in the United States that are not subject to the UAW contract. So it is having an impact. And as loose as the market is, it probably has a marginal impact.
Right.
We are going to see an acceleration in those strikes that will continue to play out for probably some period of time. And it could get more challenging if things continue that way.
Yeah, it'll only make the market looser.
It's a volume thing.
Yeah.
It has nothing to do with capacity.
Yeah.
It's all, it loosens up capacity.
But it's not
by
going to be
nature of what it does.
It's not going to be strong. Yeah.
This next question is from Stanton, who asks, how does the widening gap between Mexican imports and exports affect the domestic markets at the southern border?
It's a really important question. And I think, I went to school in the 90s in Texas. I was at Baylor University off of I-35, and NAFTA was all they talked about. NAFTA was, I think in 1993 was when Clinton signed the NAFTA legislation. And so in 1997, when I was in school, almost every class I took in the business school had something about NAFTA because everyone was convinced that this was going to drive massive economic opportunity for Texas. And it did that for a while until China basically took the steam and the momentum. It's not to say that Mexican manufacturing didn't continue to do well, cross-border traffic didn't do well. But I think what we're seeing is with UMSCA, which isn't as easy to say as NAFTA 2.0, we're seeing a resurgence of momentum along the border. We're seeing a resurgence on that I-35 corridor. We have said in past on these calls that Laredo and Houston, on a market share basis, are the strongest growing markets relative to every other market in the U.S. I think that continues to play out. So I think we will continue to see a massive momentum build in Mexico. I think we will see the Mexican president that's in power now. They're going through a presidential election. The new president is a very forward-thinking, sort of like Vicente Fox. So even though it's a woman, it's a mayor of Mexico City. She's a woman, and basically, but she's got a very forward-thinking economic policy. She's thinking about how do I bring more of the interior part of Mexico online, not just the border. And I think as we see that, there's a chance for Mexico to rise. This is going to be the Mexican decade, I think. The Tex-Mex decade is upon us. And it's not the food, but it is that whole trade corridor.
Yeah, I couldn't agree more. We talked about this several times on previous States of Freight, how Texas is perfectly positioned to be the new centroid of supply chains for the domestic, North American transportation.
There's massive reasons for that go structural beyond just the border.
Yeah.
It is, you have massive energy supplies in the state of Texas, a lot of natural resources. You've got a port in Houston. You have a lot of chemical and energy. Europe has basically shot itself in the foot when it comes to heavy manufacturing because of the lack of energy. Those plants are opening up in the South, and Texas is a primary recipient of a lot of that. So you have economic growth, you have population growth that's taking place. You've got a lot of just natural reasons of why Texas will win, but you also have this massive growth that's happening.
Do you think the infrastructure's ready for it?
Texas is good at infrastructure, like much better than than other places. Like, frankly, we live in Tennessee. Our infrastructure, our roads are not great. Texas, man, like, first of all, it's flat, right? Let's just forget. I mean, West Texas is not flat,
right?
But like, it is an easy state to build a new highway. Just go to Austin, Texas, or go to Dallas. They have no problems building, and they figured out how to make these things both sparse and quite dense at the same time. And so, Texas has a very forward-thinking business climate. It is naturally comfortable doing business with Mexico. It has the resources to win. It has the energy supplies to win. It's got the public policy to win. I am incredibly bullish on Texas.
Yeah.
God bless Texas.
I think rates are poised, though, to increase significantly out of Mexico, though.
Yeah, I think the whole Mexican trucking thing. But what's going to be interesting, we saw this in China, too. So China's rise and ascension, if you sort of studied China, Shenzhen and the south side, the Pearl River area, which is the south part of China that's connected to Hong Kong, that area was sort of the first to sort of globalize or become a global, the Shenzhen and Guangzhou. It eventually made its way up the coast to, towards Beijing and inland into Xi'an and stuff. And so what happened is Chinese manufacturing continued to move intra-country and along the coast as China westernized or capitalized on it. I think what's going to happen in Mexico is a lot of the border area is largely been tapped. Right. There's still growth there, but I think we're going to see more inland movement, which is frankly going to stabilize the country because it will continue to put economic prosperity below it. They have an immigration crisis too. Like, we talk a lot about the U.S. immigration crisis along the border. A lot of those folks that are coming from Venezuela and other parts of Latin America have to walk through Mexico and have to transverse it. And they also are dealing with a large migrant population in Mexico. They need to provide jobs for these people. They have to provide jobs for their own people, but they also have a pretty significant immigration challenge of trying to protect their own borders, which means that the government has got to figure this out. Because the alternative is organized crime and drug trafficking. And that's where I think Mexico has a real opportunity.
Fair enough.
And by the way, one more thing on Mexico is on a per hour basis, it's cheaper to produce products in Mexico than it is China. It's a pretty astounding fact.
That is.
On a per hour basis, it's it's about at least a third cheaper.
Wow. Fun fact.
Awesome. So I know we're closing in on the hour, but I want to ask one more quick question. Someone has asked if you can summarize peak season 2023 predictions in one sentence, what would you say?
Better than expected.
Better than last year.
Love it. Perfect way to end. That is all the time we have for today. Craig and Zach, thank you guys as always for joining us and sharing your insights with us. Special thanks as well to Uber Freight for partnering with us on today's webinar. And we always appreciate you, our audience, for participating and asking all these excellent questions. If you want to keep these conversations going in person, remember to join us for F3, the Future of Freight Festival. It's taking place November 7th through 9th right here in Chattanooga, Tennessee. We're bringing the industry together for 3 days of thought leadership content, networking, rapid fire demos, and special concerts and parties. That is all we have for today. Again, thank you so much for joining us for the State of Freight webinar. Thanks, everyone.